Is your money qualified or non-qualified? Now, when we think of the term qualified, we usually think of someone who is competent or qualified to perform their job. In the case of this 20, it's qualified to buy a pizza, but not qualified to buy a car. However, in the world of money, the term qualified has a unique meaning which is totally different than what it is in the real world. Now, those of us in the financial industry can be found guilty of using terminology when speaking about investments that often obscures rather than enlightens. However, in this instance, I'm going to blame the confusing language on the government entity we all love to hate. Naturally, I'm talking about the IRS. Now, the term qualified has to do with IRS tax-qualified retirement plans. Through the laws that Congress passed, the IRS has set standards for qualified monies. Any monies that aren't qualified are called non-qualified funds. Now, it's easiest to think of these two categories as money buckets. The buckets itself is the container, and inside the bucket, you can fill with different types of investments. So let's look at the first bucket, the qualified bucket. Now, there are two major categories of qualified plans. The first are employer-run retirement plans. These include the whole alphabet soup of plans: 401ks, 403bs, ESOPs, TSAs, and 457 plans. The second major category are IRAs, including traditional, SEP, Simple, and Roth accounts. All of these have strict rules that either the plan sponsor or the custodian has to follow for monies that they hold on your behalf. Now, the second bucket is the non-qualified bucket, and this includes all the other ways to own assets. You might have some savings bonds held in your name, a joint checking account with your spouse, a Uniform Gift to Minors Act for your granddaughter, and a brokerage account owned by your family trust. What's often confusing is the tendency to confuse the titling of the accounts or the bucket with the contents of that bucket. For instance, you can own stocks in either a Roth IRA or your trust. An annuity can be in your name or a traditional IRA. A mutual fund might appear in your 401k or that UGMA account. An exchange-traded fund could be in a community property account with your spouse or in a traditional IRA. The key is in separating the bucket from the stuff inside. Now, oftentimes when creating a financial plan for clients, it's important to pay attention to the types of assets that are held in qualified or non-qualified accounts from a tax perspective. Now, there may be certain advantages or disadvantages that need to be addressed, and only someone licensed to give tax advice, such as a CPA, can make that type of assessment and provide recommendations. Since I'm a certified financial planner and a CPA, this type of analysis is part of the financial planning process I provide to my clients. So if you have qualified accounts, IRAs, 401ks, etc., and would like to meet with me for a strategy session, please give our office a call at 480-503-0050. Also, click here to find out more about the 4 tax buckets, and here for an explanation of how qualified and non-qualified accounts are taxed.
This has been a Loki production.